Good morning, everybody. Let's continue with the chapter Financial Products. Financial products are essential tools for managing money. What do you mean by financial products? Financial products are those products where you normally invest, where you want to invest your funds, like savings account, investments, and insurance policies. Understanding these products is very much crucial for effective planning. If you want to have a good financial planning, then you should understand what are the financial products and how it is crucial. Is it beneficial for your objectives or not? Then you can they help in financing, achieving financial goals, managing risk, and securing a financial future. Financial products are those which helps in achieving your goal, and it also helps in managing the risk, which is risk is what a main important element of your financial planning, and also helps to have a good financial future. Then you can say then what are types of financial products you have. Types of financial products you have a savings account. First is savings account. What is savings account? Savings account is the saving account means where you save your money in a bank. You open an account in a bank where you save money, and in that account you get you earn a rate of interest. Better interest rates are available in high yielding accounts for those who are prepared to lock in money. Like suppose if you want to, when you go to a bank to open a savings account, you deposit money into the account for say for few days or for few months, and accordingly at the end of the month you on the balance available you earn interest. This is basically you are saving a part of your income into this account for your financial planning. Then you have is I I hope everyone knows now what you mean by financial planning. Then you have what are the features of savings account. Savings accounts are renowned for basically easy, available, and accessible and liquid. Means that to have a easy, accessible liquid cash, saving account is much more easily, because once you have funds in your account, you can easily go to the bank and withdraw amount with minimum balance requirement. See, for convenience, accounts come with online banking features like automatic transfers, mobile check, etc. These are available even online. You can even it's a very easy going and for withdrawing and for easy liquidity cash. Then what do you have? Then you have fixed deposits. What are fixed deposits? Fixed deposits are again they are for using it over a certain term. They fixed deposits gives guarantee returns. Normally, when you have surplus funds, you don't know where to invest. What people do easily, they go to a bank, open a fixed deposit for 1 year or for 2 years or 5 years, whatever, and they lock the amount into that account, which is known as fixed deposit. In that, you earn a high rate of interest. Okay, funds are locked in by ensuring a fixed rate of interest. Returns are predictable because at the end of, suppose if you want to keep your money for 1 year, after the end of the 1 year how much income will you earn, how much interest will you earn. So this is what returns are predictable, but in some cases returns are not predictable. Now what are the advantages of having a fixed deposit? When you compare with traditional saving with normal savings account and fixed deposit, fixed deposits offer a higher rate of interest as compared to savings account. They are regarded as a safe because you cannot remove, once you open a FD, you cannot remove it during the time period. You can only remove only after your time period is over. Then what do you have? Then you have mutual funds. What are mutual funds? Again, it is one of the most important financial products for your financial planning. Mutual funds combine the capital of numerous investors to buy a variety of securities. What do you do in mutual funds? Mutual fund means the financial advisors comes together, they take investors fund and they combine the capital into varieties of securities. This enables diversification among several asset classes, which lowers the risk. The risk out here is low. They make investment easier for people who might not have time for experience and managing by professional. Means that suppose you're working, you don't have time to manage how to manage your investments. What do they do? They go and invest in mutual funds. What do they invest? What do they do in mutual funds? They take the money and they invest in small diversified portfolio. Some in banking sector, some in insurance sector, some in industrial sector, etc. So they're managed by the professionals. Then nowadays mutual funds also has become an important element for your financial products. There are very common types of mutual funds. Common types of mutual funds. You have debt funds, which makes debt funds normally what do they do? They're also one of the advantages is that for investors that they make investment in fixed income instrument, whereas in equity they invest in stocks. Whereas thirdly you have hybrid funds, which gives common to both. You have debt and equity and a well-rounded strategy. Then what do you have? You have index funds. Index funds are generally less expensive, but they follow a market indices. Means that these funds are generally follow the market indexes and they are very less expensive to invest. Okay. Then you have stocks and shares. What are stocks and shares? Stocks are symbols of ownership in a business. Means that whenever you purchase stocks from the stock market, what do they symbol? They symbol that you're the owner of the business, whether you have the ownership of the business. Purchasing shares makes you the co-owner of the business. When you purchase shares of a company, you become the co-owner of the business. High returns are possible with stocks. You can say some stocks give you high returns, some stocks don't give you high returns, some stocks are risky, some stocks are not risky. It all depends on stocks you buy. There are a lot of volatility in the stock price. So depend on stock price, you know how risky, which stock is risky, which stock is not risky, etc. Then purchasing and vending equities. On exchanges, now you know there are two main exchanges, BSE and NSE. Stocks can be purchased and sold from here on this indexes, on this platform. BSE, Bombay Stock Exchange, and NSE, National Stock Exchange. Stocks can be purchased and sold from these exchanges. Brokerage accounts are used by investors to streamline transactions. You can say, for example, a market order purchases stocks at the current price, but the limit order purchases it at predetermined price. Are you able to place an order for stock? So this is what, again, stocks. This is all related to stocks. Then what are bonds? I hope now after learning so much about debt borrowing, you should know what is bonds. Debt securities issued by companies or governments are called as bonds. What are bonds? Debt securities issued by companies or governments, they're called as bonds. Lending money to the bond issues. What happens when they purchase one? When one investor purchases bond, what happens to them? The issuer gradually repays the loan with interest. When the issuer, the one who issues the bond, will have to pay the principal along with the interest. Making wise decision is aided by having a thorough understanding of bonds. If you want to add bonds in your financial planning, before adding it, you should be aware of you should have a thorough understanding of bonds. Should I take this? Should I add in my investments or not? Or will it, if I add, will have an adverse effect or not? All this it should be decided before investing in bonds. Then there are different types of bonds, such as corporate bond, municipal bond, government bond, etc. Each has a varied risk and return. Each bond has its own risk and its return profile. It all depends upon the risk and return, which normally an investor has to choose. Corporate bonds might have greater yields, but government bonds are usually safer. Depending upon the type of bond and type of your goal, you should always decide which bond, if you want to go for bond, which bond you should take, which bond is suits your goal, suits your investments, and etc. Then you have insurance product. Insurance products, again, there are different types of insurance. You have life insurance, health insurance, and property insurance. These types of insurance exist to protect against risk, meaning that these type of insurance we take, it helps us to protect against the risk. Life insurance provides financial security for loved ones in case of untimely death. If suppose unsudden death or it happens, if death occurs, then what? Then life insurance provides security, financial security to your loved ones or to the legal heirs. Then you have health insurance. What is health insurance? Health insurance it covers medical expenses, while property insurance protects physical assets like homes and cars. Suppose if you have a property, you have to ensure that if there is any damage or any fire occurred, then you need to protect your property through how will you take? You will take insurance, you will take property insurance, which you will get financial security against your property. What are the importance of insurance? Insurance mitigates financial risk. What does mitigate? It reduces your financial risk associated with unforeseen events. Any unforeseen or any uncertain event like earthquake or any floods or any tsunamis coming. Then this insurance helps to reduce the financial risk. It ensures financial stability during difficult times. Insurance is also one of the most important type of financial products. Now comes real estate investments. What is real estate investments? Real estate investments are those which an investor wants to invest in properties and houses, etc. What are the advantages of real estate investments? Investing in real estate have many advantages. It offers possibility of capital appreciation. One of the main advantage of investing in real estate investment is capital appreciation. Additionally, capable of producing rental income. It helps to produce rental income. It provides a steady flow of cash. And furthermore, market demand may cause property values to increase. Normally, if you invest in real estate markets, it helps in this helps in gives you have this helps in increase in property value, and is normally a cash inflow and not of so much of cash out. It's so nowadays people prefer to invest in real estate now because there's capital appreciation, there's a steady flow of cash of rental income, there is a capital, the property value increases, and etc. This kind of investment is chosen by the investors. Then you have kind of investments in real estate. There are different kind of investments in real estate. What are they? They are apartments and single family homes are examples of residential properties. Then you have retail establishments and office buildings are considered as commercial properties. An option to invest in real estate without taking direct ownership is through real estate or REITs, which they are different types of profile which gives you high risk or returns. Then you have is ETF. What are ETF? ETF is exchange traded funds. These are again, if a financial if an investor has financial literacy about ETF, exchange traded funds, then they can invest in this type of product. What is it? Stock exchange trade investment funds known as ETF. They possess an investment such as stocks, bonds, or commodities. ETF offers liquidity and diversification by using the characteristics of stocks and mutual funds. What are they? They are exchange traded funds where these are available on stock exchange, and they provide an investment on these ETF, and they have it's a you can say nowadays ETF can track the performance of multiple tech companies, and it's a technology. If a financial advisor has knowledge for ETF, they can go for investing in ETF. Then what are the distinguishes between ETF from mutual funds? Mutual funds and ETFs, they are not same, but they're similar. Unlike stocks, which are purchased at the close of trading, ETFs are traded on exchange. Means that you purchase stocks at the close of trading, whereas ETFs are traded on exchanges. Generally, ETFs expenses ratio are lower than those of, means that whenever you purchase ETF, the expense ratio is lower as compared to you purchase mutual funds. So depending upon the expenses and incomes, you can even think of, investor can think of purchasing ETF. Then you have cryptocurrency. What are cryptocurrency? Virtual or digital currencies with cryptography based securities is known as cryptocurrency. Means any virtual currencies are known as cryptocurrency. Utilizing blockchain technology, they function on decentralized networks. These work on decentralized networks. And you have Bitcoin. If you know about this fundamentals of cryptocurrency, then you can even also invest in cryptocurrency, virtual, digital assets, etc. Then what is peer-to-peer lending? What is lending between peers? See, without using the traditional banks, see earlier bank was not there, but now earlier how do people used to lend? They used to lend between two peoples, or between people who lends and who borrows through peer to peer. But now, as nowadays banks have been organized, have come, so lending peer to peer lending has been reduced, or as you can say, it has been almost nil. Online resources offer competitive interest rate linked lenders and borrowing. Means that when there's a peer-to-peer lending, means there are one borrower, there's one lender. So then on basis on these borrower and lender, they decide the interest rates, and accordingly they make the transaction. What are the pros and cons of peer-to-peer lending? When comparing traditionally savings to peer-to-peer lending, investors may receive higher returns. When you do peer-to-peer lending, the investor who lends receives higher returns, but there are risks associated with it, like borrower defaults. Like if suppose there's also risk that if borrower doesn't give on time, he defaults, then what? Risk can be reduced by being aware of the platform terms and by reviewing borrowers' profiles. One can reduce your risk by how? By you should be aware of the platform terms, like the terms and conditions while before borrowing. And before borrowing, you should know the borrower's profile. How is he? Is he capable of borrowing? What is his financial stability, and etc. Then you have financial derivatives. Recognizing derivatives, contracts that have underlying assets and they, as their value source are known as financial derivatives. There are two types. You have options and future contracts are among them. One can use derivatives to speculate on price movements or to hedge risk. What you can do on stock exchanges, you can speculate the price and on price move, like how the price goes up and down. You can just check on the price movement and accordingly you can do speculate and then you can do or you can hedge. There are different types of derivatives. They are different types of derivatives. What are they? They are futures, they are swaps, and options, which are nowadays very common of derivatives. Then what are options? Grant you ability to purchase or sell at an item in a predetermined cost. What is option? Options you can purchase or sell at a predetermined cost means at a cost which is already defined in before making a contract. With futures, what do futures do? An asset must be purchased or sold at fixed price at a later time. Means you fix a price today and suppose after 1 year you have to purchase. So today you fix a price and after 1 year you purchased at the fixed price. Different investment strategies and risk follows are catered by this type. Now you have investment strategies. Again, you know there are different types. There are two types of investment strategies you can go for. You can go for long term or you can go for short term. Long term and short term. The goal of long term investment is growth over a number of years. Means when you want to invest, if your goal is to invest for long term, means you can say for like you want in the next 10 or 15 years, you can go for your goal should be long term. And if you want your returns within a year or 2 years, you can go for short term. Depending upon your goal, you should choose what type of strategies you want. I hope you understood this chapter. If you have any queries, please like and share and subscribe. Thank you.